it is understood that it is income tax.
Correct. Correct.
I think there is that much changes are not there.
So we
Okay.
might do something later. Let's say whenever the budget happens, at that time, definitely, I think we will
There will be
be able
something.
to do. Yeah, there will be something on direct tax. Right now, there is nothing.
But in case of direct taxation, the impact will be later on in the filing of the assessment.
Correct.
Everything happens for the subsequent financial year.
Correct. Sir. Correct.
Yeah, immediate impact will not be there.
Correct. Correct.
So that is the reason I think many of them are not having any webinar on direct
Direct
taxation.
Correct. Correct.
Now full budget will be coming. No?
What, madam?
Full budget will be coming now after this.
Yeah.
Assumes charge. So, Pillai sir, shall we start now? Shall we start after that? Welcome and all. Now we have 25 members, attendees.
Yeah, that's good.
So shall we start now?
Yeah, what is the number we are expecting? Any idea?
70, 80, 85 members are registered. So after we finishing our welcome and all those things, they will be joining.
Okay. Yeah. Once the
So we
main
should-
program
okay.
starts, people will be online. Okay, that's good. And also keep a practice of doing like exactly on time so that everyone will
Yeah, now
come to know
it's
that
3 o'clock.
they're keeping the time. Right. Go ahead then. Thank you.
Good afternoon to all. Welcome all to this webinar. Let me introduce EPCES first. Export Promotion Council for EOU and SEZ functions under the Ministry of Commerce and Industry to support EOUs and SEZ units. We extend services mainly organizing webinars, seminars to educate or update the various changes that has impact on the SEZ and EOUs. EPCES acts as a bridge between the trade and the various government organizations to take up the concerns of the trade for a favorable solution. Compensation says RODTP, etc. are a few of our success stories. Now, let me do the business of welcoming. First, I wish to welcome our chairman, Sri KK Pillai, to this event, sir. Sir, warm welcome to this program.
Thank you.
Today is our knowledge partner, BDO LLP India LLP, sorry. I think they do not need any introduction because they have associated in so many programs related to EPCES. Their two eminent partners are here with us to explain the GST updates and its implications on SEZ and EOUs. They will be mainly focusing on SEZ and EOUs. Mr. Siddharth Tandon is a partner with the indirect tax practice with a focus on customs, foreign trade policy, and government incentives. He has over 15 years of experience and operates out of the New Delhi office. His professional experience is across the spectrum of indirect tax advisory, controversy management, and complaints management, including stints with the leading tax firms and larger accounting firms. So he is also an advisor on diverse cross-border and domestic indirect tax matters, including determining tax optimal business models. He is highly experienced in matters pertaining to the central and state governments for greenfield and brownfield investments. And our next partner is Mr. Karthik Mani. He is also a partner with the indirect tax practice of BDO India at Bangalore office, bringing over 12 years of professional experience in indirect tax structuring, advisory, litigation, and SEZ related matters. Prior to joining BDO India, Karthik worked with a large consulting firm in a similar role. He has assisted large organizations in the manufacturing, IT, ITES, e-commerce, retail, banking, and insurance sectors. His expertise include managing end-to-end indirect tax engagements, such as indirect tax supply chain advisory, litigation support, refund claims support, tax presentations, and GST compliance outsourcing. Karthik has also advised and assisted clients in setting up SEZ and EOUs operations in India. Now, I would like to welcome Uvaya sir, my colleague, to this program, and all RDs who were supported and joined in this program. And I take this opportunity to invite all attendees to this program. I hope this will be a beneficial one for them. Now I request our chairman Pillai sir to have inaugural speech.
Okay, thank you, ma'am.
Sir, please.
Well, again, good afternoon to all of you. I think some of the participants came a little later. So, my dear Mr.
Now it's
Siddharth
47,
Tandon.
sir, already.
Sorry?
It's 47 already. They are coming.
Oh, very good, very good, very good. Dear Siddharth Tandon, dear Karthik Mani, partners of India Indirect Tax BDO India LLP, and my dear two RDs, Sri Poya and Supriya ji, as well as my esteemed partners of business cluster from Kerala as well as Karnataka, maybe from other states also. It is indeed our RDs selected the right subject on right time. GST and indirect tax is one of the main criteria which affects the exporters on and off. If I could tell, the 53rd GST Council meeting held on 22nd of this month made many recommendations which I could also go through. Many of our members also might have gone. However, the changes that they have recommended may come into force in short time. All these issues we were taking up long ago, but only because of the new changes coming in and the new government also has come on place, we are happy that the same person, the finance minister is same, commerce minister is same. So we could approach them without any problem and they continue to act the way they were going on. So I understand that the pre-deposit has been recommended for reduction. 3 months period for filing appeal also has been put forward. Under Section 50 of CGST Act to amend interest on delayed filing out and return, exemption of compensation cess for SEZs. That is one of the main subject we addressed very specially from Cochin. And thanks God, we could get a reply, an interim, sort of recovery for the industries to go forward. They have set the ball going with an order saying that the same status quo has to be continued. That was a great achievement for our companies in the zone, and it affected all over India. And then insertion of Section 128A in the CGST Acts to provide conditional waiver of interest on penalty relating to demand raised under Section 73 of the years 2017 to 2020. Then standardization of interest rate in various grouping products also to be taken up, which I think our people will be able to understand that. So these are the main changes coming in forward. And I am sure with the deliberations of our two experts today, our members should be able to get the right position at the right time, which is prevailing, and what are all recommendations put forward and how it can be benefited, how people would be able to act on that, all these factors. So I wish both of you to go ahead with the excellent presentation so that the people could buy and making the day very good. Wish you all the very best, and thank you for making me also to be present in this function. Good luck. Good day. Thank you.
Thank you very much, sir. Now, Mr. Karthik and Mr. Siddharth, the platform is yours. You can start the presentation.
Sure. Thank you so much, Supriya ma'am and Pillai sir, for setting the context. I think I'll just put up my screen as well. I hope my screen is visible now.
Yeah.
Yeah, great. So I think, just as we are beginning, just to set the context, as Pillai sir said that this council meeting has brought in a lot of elements for the industry, and the entire ethos of this meeting was to factor in industry feedback across forums, whether it's from an exports standpoint, local sales, and a lot of focus was on audit assessments and litigation. So I think that's one of the key elements that has been the storyline, and what we have seen in the council meeting, and then of course the press note came out, was that they want to cover a lot of points. And the press note also mentioned a huge list of circulars as well. Now, many of those circulars are out. And, I think many of us have had a chance to look at those circulars. Some of those circulars are still awaited, I think, like corporate guarantees or, one or two others. So, all in all, I think the overall direction is positive in terms of easing some burden on the taxpayers. As we walk through this session today, what we'll see is and discuss and share some of our thoughts that probably in some of the circulars, there are certain elements which would need some more clarity. And probably as we see how the next 2 months evolve, maybe those elements would also get addressed, because in the next 2 months, we are expecting two things. In July, we have the budget which is expected to bring in a lot of amendments. And then the next GST Council meeting, as Honorable Finance Minister had mentioned in the press briefing, is expected to happen by mid-August. So if that happens, and the tone of that, the next council meeting is also focused around a lot of industry representation and feedback. So in the next 2 months, there would be a lot of action. There would be many circulars, notifications coming our way. So I think as a group, we need to sort of stay focused, make sure that we are able to harness and benefit from those changes positively. And of course, there would be open issues, but I think it's a journey which we all need to take together. So moving on to the specifics, we'll start with what are the changes around the adjudication process that have happened in terms of timelines, in terms of other elements. So to begin with, the first element that we wanted to touch upon was that the government has now proposed that right they want to simplify the entire time limit element from an appeal filing or from a entire litigation process, and that starts with the inception of proceedings. So right now, the way the law reads, from a normal situation, the period of limitation is 3 years under Section 73, which is basically a case which doesn't involve fraud, suppression, etc. And the other section, which is Section 74, uh, has a time limit of 5 years for initiation of any proceedings against the taxpayer if there is any fraud, suppression, etc. Now, the government is looking to merge these two timelines so that there is no confusion or there is no overlap. Now, there are two elements to this. One is that historically, if you look at central excise or service tax laws, etc., there have been two timelines at all times, and they have worked in that fashion. But now the government is relooking at aligning things. Even the revised central excise bill that has that came out few weeks back, that also had a common time limit of 3 years proposed for all cases, which means cases involving fraud, suppression, and other cases as well. So here, when we talk from a GST perspective, at this stage, the government has not mentioned what would be the new time limit, whether it would be 3 years or 5 years for all cases. But if central excise bill is anything to go by, it could be a case of 3 years. But this is something which we need to watch out for in case the government decides otherwise and makes a common time limit of 5 years for initiation of proceedings for any particular year. Then of course it expands the base for the authorities to really pick up litigation. So hopefully, based on the entire intent and how the meeting went, looks like that the uh, alignment should be more towards 3 years period for all cases, but this is something which we would need to watch out for. The other element, the next one is around some relaxation on interest, specifically in those cases where interest or penalty was raised, and people experience technical glitches in filing of returns. So, say for example, there is balance in the cash ledger, but the return got stuck or could not be filed, and there was a delay of few days. Then in those cases, there have been demands as well. So now the government has understood that gap, and they've said that at least it's a clean intent from a taxpayer side. So for those cases wherever the money was sitting in the electronic cash ledger, and return was filed at a later date, their interest penalty etc. should not apply. Now this also becomes important because previously in the last few months we have seen there have been judgments, whether it's Eicher Motor or Syncon or even others, which have had contradictory thoughts around this topic. So clarification in this regard is welcome. Even now, there would be certain open cases and situations as to how authorities would really look at it, and we'll need to see in terms of all situations and adaptation at the ground level of for really extending the relief in this regard. This one, the next one that I wanted to touch upon was regarding an amnesty scheme of sorts, which basically pertains to the past years of 17-18, 18-19, as well as 19-20, where the intention of the government is that, look, in the initial years of GST, there may have been gaps from the taxpayers, maybe in terms of understanding the law, maybe in terms of implementation of the requirements, etc. And therefore, relaxation was brought in at this point in time, that wherever tax has been paid by the taxpayer, interest and penalty could get waived off. Now, there are certain elements to this proposition, and of course, this would come in through the budget. Right now, this is a proposal that is there captured in the council minutes. So, what the government is proposing is that for these past 3 years, which were the initial years of GST, if there are any demands where amount has been paid or the SSE intends to pay up to March 31st, 2025, their interest and penalty should be waived off. So if you would recall, under the service tax regime as well, there was a scheme, amnesty scheme, which was SVLDRS. Now, of course, there were certain additional elements in that scheme. There was partial waiver of the tax amount as well. So this may not be as aggressive a policy, but certainly this is a welcome move for closure of lot of litigation matters, especially for the first 3 years. Now, at this stage, and this is what I wanted to spend a couple of minutes on. It's important to understand that it's not clear as to how this framework would work in terms of the mechanism for application for this scheme. Uh, what is the process? Would it be an online process similar to what we have seen in other amnesty schemes? Secondly, if one were to adopt or opt for this scheme for a particular year or for a particular issue as well, would the department hold it as a precedent, which ideally shouldn't happen in case of an amnesty scheme? But these are things which we need to see, because in the initial years or in certain situations, a taxpayer may feel that we would want to close certain litigation purely because of, in some cases, of low amounts involved, etc. However, if in a subsequent period the amounts involved are high, then the taxpayer may want to litigate in that period. So, say for example, if the same issue is there in 1819, 1920, you may want to close the litigation if the amounts are not significant. But if in the subsequent years that type of transaction sort of increased and the quantums are high, you may still want to litigate. So therefore, we need to see how the department really looks at it. The other thing is wherever interest or penalty has been paid, is there a situation of refund of whatever excess amounts of interest or penalty have been paid? Now, typically, again, going back to the service tax scheme or even other amnesty schemes, whatever amount has been paid till the introduction of amnesty scheme, generally they are not refunded. So if we look at the past trends, probably we are not looking or expecting really refunds of interest penalty wherever they have been paid, unless the government is kind enough to extend an exception this time. But based on the past trends, it doesn't seem to be likely. The other element that we also wanted to touch upon here is that at this stage, we have a very brief description of this scheme in the document because it talks about the demand in the notice. Now, all of us have had situations where the demand in the notice was much higher versus when we received the adjudication order. So this talks about depositing the money that of the amount of tax which was raised in the notice. So if my amount in dispute is much lesser in the order, so would the amount in order be good enough to be paid? So that again is an element. Supriya ma'am, you have raised a question, I guess. You're on mute.
I was taking that, that's
Okay, sure.
okay, you can continue.
Sure. So I think so this becomes important. So I think it's as taxpayer, it's important to see that this is a significant step. But in terms of the framework of the scheme, we need to still do a wait and watch, understand the nuances of the scheme, what are the four corners within which it would operate, and in appropriate cases, then move ahead and opt for this scheme. So this is very interesting, but with details to be looked at. And at this stage, there are several propositions which have come out where details are still awaited. So this is one of the key ones where we need to look out for. The other element which is comparatively much more straightforward and which would of course come out as part of the finance bill is that the regular in all the regular cases where the initial time limit of 30 days was provided for a lower amount of penalty has now been extended to 60 days. So that's a welcome move. It's straightforward. And I think the government understands that sometimes it may, the taxpayer may need some more time to evaluate a matter and then, take a call of paying the taxes. So this is certainly going to be helpful. Now, as we move to the proceedings, the entire appellate process, what has happened is one is the pre-deposits amounts, they have been moderated a bit. Now, is it a significant drop? Maybe not, because in a lot of litigation matters, things may not get impacted. Say, for example, the first level pre-deposit was 10%, that remains 10%. The only thing is that the maximum amount, which is the capping of pre-deposit, from 25 CR of the pre-depositor under CGST and SGST respectively, that has been brought to 20 CR under both the tax laws. So I think there is slight moderation there, but not something very significant. And again, at the next step, which is the appellate tribunal, there I think something notable has happened, that the pre-deposit amount has been reduced from 20% to 10%. For the second appellate level, and even the amounts have been moderated a bit. So overall, the steps are in the right direction. That cumulatively, if you look at it right now, when you go to Joint Commissioner Appeals, which is the first level, the amount of pre-deposit would now be 10%, and which was the case earlier as well. And the second level would also be 10%, which was earlier 20%. So there is definitely moderation in that. But still, the pre-deposits may be cumbersome for a lot of companies, specifically for MSMEs. So that's something that would, the steps are in the right direction, but I think the impact would really, sort of be dependent on the profile of the taxpayer. The other element is that anti-profiteering cases, and which I think we knew, I think there have been discussions around it. would now be handled by the principal bench of GST Appellate Tribunal, which would be set up soon. I think there have been a lot of discussions around it, and that's why the timelines for filing of the appeal have, as well before the tribunal have been extended. So there is a lot of expectation from these appellate tribunals, both in terms of catering to these appeals and dealing with the past, anti-profiteering matters. So this is something that would kick in. Now, in terms of where the department can go and appeal, that's the other side of the story where changes have come in. Monetary limits have been advised. Now that provision or that power already existed in the law. Now that has been exercised and limits have been set out that if the department wants to appeal against an order, then the limit to appeal before the tribunal is 20 lakhs for pure tax amount. Before High Court, it's 1 crore, and before Supreme Court, it's 2 crores. Now, of course, if it's tax interest penalty, the amount we are talking about is only with respect to tax. In cases of interest and penalty, only those amounts. So I think the direction is again positive. However, another interesting element that one would need to evaluate, and maybe as things sort of evolve, we'll need to see exactly what kind of cases would get covered here, because the exclusion from this monetary limit, the list of exclusions is huge. So if we look at it, the exclusions we are talking about, one is where the any provision is challenged, and if a demand is pursuant to that clause or section, then this limit doesn't apply. Any matters involving valuation, classification, refunds, or place of supply, those matters are excluded from this monetary limit from a department's perspective. And a very wide exclusion is any other matter recurring in nature or which involves interpretation. That gets excluded. So, that would have to be seen as to how the authorities view these clauses. So, say, for example, can somebody say that if a company has 2A, 3B reconciliation issues in a particular year, and there are demands year on year, and if you get a favorable order at, say, for example, JC appeals, and the department wants to further go and appeal, can they say that this is a recurrent issue for the taxpayer across years, and hence they fall under this exclusion? So I'm just throwing up just one example. Now, we don't know how authorities would look at it, and what are the broad guidelines for the officers to really construe this in a constructive manner, and which would actually help in reducing litigation, because the entire focus of this amendment is to actually reduce litigation. So this is where a key element is sort of brought in. And of course, wherever there is we have a situation of multiple years, multiple notices being pegged together, the thresholds would apply at an aggregate level. That's another important element, and not at a year by year level. So if the demands and orders are separate, then it would apply respectively. But if it's all cumulatively bundled up in an order, then the aggregate amounts would be looked at. So there are some interesting elements to this, but I think in terms of key areas to watch out for under this would be the list of exclusions. So wherever we have these elements, we'll need to understand how, one, the government looks at it, and two, how the ground level field officers understand and implement this. The other element is around sunset provision for anti-profiteering provisions. Now, when the GST laws came in, the anti-profiteering provisions had come to safeguard the interest of consumers. And there has always been a discussion that now, since it's been a while, it's been a good 7 years, uh, was this clause intended to be in perpetuity, or was this only for a limited period? And I think after a lot of feedback from the industry and a lot of brainstorming within the government as well, they've brought in a sunset to this, that any new applications from an anti-profiteering perspective would only be accepted up to 1st April 2025. And that's a sunset clause for inviting any new issues or applications under this clause. After this, only those wherever the applications are open or people are in appeal, specifically say for example where in the case of Reckitt, this is the clause itself is under challenge, or other proceedings which are open, only those matters would continue to be dealt with by the courts and authorities, and new matters would not be entertained. So this certainly brings in some certainty for the industry. From a litigation standpoint, again, one another important aspect is that if during audit, investigation, or inquiry, etc., at any point in time, the taxpayer has deposited any money, and then the matter culminates into a show cause notice, and then there is a proceeding, and then you go into an appeal, that amount can be treated as a pre-deposit, and whatever you have deposited through GST DRC 03, that amount can now be adjusted against and treated as a pre-deposit for that litigation matter. So this is again a welcome move, because a lot of times companies made certain payments during the investigations, and after they got some time to evaluate the legal and technical aspects, they felt that they would want to litigate rather than pay up, and therefore this amount that they paid in the interim was sort of lost in transit. I mean, this was an extra payment and then not really treated as pre-deposit. So this is again a welcome move from the government to ease the entire journey in the litigation process. From an input tax credit perspective, again, there are several elements that have been brought in. One is that if you look at the past, there were a lot of cases where there have been gaps by the taxpayers in terms of recording of invoices. In some cases, late recording of credits. In certain cases, premature recording of credits. So there was a mix and match. I think people were still grappling with uh, compliance issues in the early times. So those have been sort of put to rest, where the government says that now the new timeline, all the extended timeline would be 30th November 2021 for all the financial years from 2017-18 to 2021 for claiming credits. So if you had claimed something which was off the time limits and which was under challenge by the authorities, that becomes a good credit. Now, this also raises a question that, if companies which sort of missed out credits, or they understood or took note of this, and at the time of annual returns or other elements, they actually dropped such credit, what happens to that? So it doesn't cover those situations at this moment. It only talks about where credit was claimed, but probably the time limit was not followed. So wherever those valid credits were not claimed, were missed, or whatever. So, I mean, those situations don't seem to be covered, but it may not therefore give full relief, but definitely gives relief to a lot of cases where people were fighting out credit eligibility on the basis of timelines purely. Similarly, I think there was a lot of concern around transition credits, around invoices on ISD. So that itself has been addressed, and now that credit is also, would be allowed. So again, these are nuances which have been brought up time and again through different forums before the authorities in terms of pain point, and in terms of putting out that yes, these credit claims are legit claims. There is no ineligibility involved, but purely because of the mechanism, they could not really transition this credit. Then there are certain other elements which we wanted to briefly touch upon, highlighting the core, essence involved. For certain clarifications, again, a lot of these are based on industry feedbacks. Now, while this may look like specific for ducts and manholes for optical fiber cables, there could be larger implications, or we can understand and extrapolate this in other situations as well, where basically the law doesn't allow input tax credit of works contract, whatever is incurred for creation of immovable property, etc. But in cases of where something qualifies as plant and machinery, there the input tax credit is available. Now, in this case, from a telecommunication industry perspective, the ducts and in the plastic pipes, etc., and the manholes that were created, which were used for installation, upkeep, and maintenance of these optical fiber networks, whatever works contract was involved, the credit has been allowed because that it has been clarified that this is part of the plant and machinery, and without these ducts and manholes, it's almost impossible to have them functioning and keep them up and running. So therefore, this is essential part of the plant and machinery, and credit should be allowed. So while for a lot of the members on this forum, uh, optical fibers may not be the situation, but I think this can be extrapolated and looked at from a different lens as to the intention of the government to allow credits wherever uh, something has been done to make sure that the plant and machinery is working, without which the function itself or the upkeep would not be possible. The other element which is important from an input tax credit perspective, and of course has been litigated a lot. There have been a lot of situations being looked at is from a reverse charge perspective. And of course, I think a lot of debate started around secondment issues or other issues as well. Whether a reverse charge liability should be paid on cases between related parties, and there were both kind of situations, one where consideration was available, one where there was no consideration charged by the unregistered taxpayer or the offshore parties in that sense. And a lot of debates, a lot of demands were being issued. Now what the government has come out to clarify is that wherever full credit is available, there the liability should not arise on the taxpayer. So what they have done is that if you have an RCM liability in case of, say, import of services, the day you recognize that liability, you are able to claim the credit. Now, of course, if there's a delay, you are liable to pay interest, but at least your credit eligibility does not get killed. So that's the core that they have focused on. And a lot of these cases emerged in situations where if a jurisprudence or a judicial pronouncement has come out, and then the taxpayer has taken a call that, okay, let me pay the tax, claim credit, and move on. There's no point litigating. Then at least you are in that position to claim that credit uh, and then move on as soon as you pay the tax. Because we saw in a lot of cases where the department was actually disputing the availability of credit, saying that this was pointed out as part of the investigation. And therefore, this is not a situation where credit should have been admissible. So now again, there are a lot of open issues around this, a lot of open elements as to what all situations does it apply to. Does it apply to situations of fraud suppression, etc. as well? So there are a lot of open elements, and maybe as in the next 2 months, as we spoke, that there would be a lot more clarifications, amendments in the law as well. Probably there would be finer nuances that would be touched upon by the authorities. So I think that's where we need to keep an eye. But at least if there are any disputes around this in terms of related party transactions, this is something that we need to understand as to and sort of map it as to where we have an exposure and where we don't. So this is something that a lot of companies would need to go back to the drawing board to understand the real exposure in these cases and wherever those demands can be wrapped up. So I think moving on to taxability and rates. So I think again some positive moves from the government in terms of clarifications, where a lot of group companies extended loans to the subsidiary. So a lot of those cases were there, or sister concerns. There would be a lot of intra-group arrangements. So now at least a clarification has come out where the government has clearly stated that loans per se, of course, are not subject to GST. If there are any processing charges, administrative charges, or any other charges for facilitating this amount, only that amount would be subject to GST, not the loan itself. So I think this, while the industry was taking this stand, this was still being raised by officers in several locations. The other element is also very similar, where we are talking about reimbursement of securities and shares, ESOPs, etc., by a company to its employees. So again, the government, on a very I would say high level basis, has clarified that ESOPs or these securities, when we talk about employees, one, that these are securities. Two, ESOPs are part of employees' compensation structure. So in any case, that is not subject to GST. And when we are talking about ESOPs, a lot of times it would be of the parent entity, and because of that, there would be a lot of transactions between the group entities. So the government has clarified that those interchanges are not subject to GST, only if there is any fee involved or there are any charges related to ESOPs, related to these facilitating ESOPs charged between the group entities, etc. Only those fees or facilitation charges, etc., would be subject to GST. So ESOPs are not subject to GST, or any debits between the entities regarding to ESOPs. They are not subject to GST if they purely reflect the amount of the securities itself, and not any charges, facilitation charges, etc. So this is again a welcome move, and all the companies where ESOPs is prominent, this is a much needed respite. I think moving on from ESOPs, the next one is around warranties. Again, several elements were involved from a warranty standpoint. One was, there have been clarifications earlier, but it was always considered, by some jurisdictions in a broken manner, because the earlier clarification said that if the warranty, if there are any replacements under warranty of parts, then there is no new GST liability that arises. But that also left an open question, which the authorities raised, that the circular only talks about parts, but where the product itself is replaced, it doesn't talk about those situations, and therefore that should be a new supply. Now this has been clarified, where the earlier circular has been proposed to be amended, and they've said that what we meant and what we want to include is that whether under a warranty parts are replaced or the whole product itself is replaced, it is not a new supply. It is, the value itself was covered in the original supply, so there is nothing, no new transaction really emanates. And that puts to rest a lot of controversy. The other element was wherever distributors were involved, and they had to replenish any warranty items from their pool, and then they would get a replacement from the OEM. Even there, they have said it's not any new transaction, it's just extending of warranty. So again, no reversal of credits, no payment of GST required. And even in cases of extended warranty, they have clarified that only if the extended warranty was sold by the OEM at the time of the sale of the original product, only in that particular case it would be treated as a composite supply. In all other cases, it would be considered as a distinct supply or an independent supply, regardless of what was the original underlying product. Because in a lot of cases, extended warranty could be sold by the OEM at a later point in time, or extended warranty could be sold by third parties. In either of the cases, they have said that that would be an independent supply. It has nothing to do with the original underlying supply. So that again is sort of really clarificatory and addresses a lot of open items around warranty supplies, because we have seen notices around this in several jurisdictions. So at least some litigation matters would definitely be put to rest with this. So I think now we would have issues around valuation and other elements, and maybe I'll request my colleague Karthik Mani to take over from here and take us through all those elements, the identified elements that we thought are relevant for this group. And then probably at the end, we can take some questions as well. So Karthik, over to you.
Thank you, Siddharth. Good afternoon, everyone. Hope the screen is visible.
So Karthik, are you sharing your screen or should I?
I've shared my screen.
Okay. Let me just stop sharing.
Perfect.
Yeah.
So, cool. Thank you, Siddharth. And on the recommendations relating to valuation. So this is the provision rule in Rule 28, where there is a second provision which says that whenever a transaction is happening between any related parties or any deemed distinct person, when I say deemed distinct person, it is same PAN, multiple GST registration. The valuation always been a contention and issue with the tax authorities. There was a circular issued last year, circular number 199 in July 2023, wherein it clarified, using the same provision, it clarified that the cross-charge was a big issue from the initial GST introduction date, where whether the head office to branch office and branch office to head office transaction needs to be valued in a different way. So this provision gives a relaxation which says that if the input tax credit is eligible to the receiver, you can adopt any value. Whatever value you adopt will be treated as an open market value until you satisfy the condition that input tax credit is eligible. Now, this proviso was used last year for clarifying on cross-charge related transaction, but the tax authorities found some interpretation even in that circular saying, if the services are provided from third party to your head office, then we will not consider it for this circular. Only if it is internally generated services, that is, head office is providing services to branch office or branch office is providing services to head office, then circular applies. So that is an issue which needs to be addressed because this is coming out from interpretation of the tax authorities. Now, this same proviso is being used for the purpose of other transaction. Let's say now corporate guarantee for that matter, right? Corporate guarantee, there was an amendment last year wherein the amendment said 1% of the value of your loan, which you are for corporate guarantee, which you're factoring, should be considered as a value for levying GST. So this created a lot of issues because a lot of entities, parent entities who are giving corporate guarantee to their subsidiaries for availing loans had huge values. Let's say they would have given a loan for, let's say, 1,000 crores. 1% of it is a big amount on which you have to pay 18% GST. Now they are bringing in relaxation here where they're using this proviso, Rule 28, Proviso 2, saying that if it is between two related party and if the receiver can take full input tax credit, then you don't need to do a GST payment on corporate guarantee. This 1% rule doesn't apply. So basically, this will apply only when instances where ITC is not eligible for the receiver. So that is on corporate guarantee. Now, the second part, wherein it is relating to imports from related parties. So this is a critical issue. Let's say cases like Northern Operating System, okay, wherein the Indian entity was getting services from their overseas entity. And you cannot say services. Basically, the employees of overseas entity used to come and sit in India and perform certain activities, and they were treated as employees of the Indian entity. For these transactions, there are no services that the overseas entity was giving to the Indian entity. Now this became a big issue. Even Supreme Court gave a ruling against the taxpayer saying that this will qualify as a import of services from overseas entity to India, and we have to pay GST and a reverse charge and take credit of that ITC paid. Now issues like this, based on this judgment, several notices were issued to taxpayer saying you are having expats in India and this will qualify as import of services and you need to pay GST and a reverse charge. These notices, what will be the status of these notices after this circular? We need to wait and see, because what we are ending up seeing is that if there is a transaction between my overseas entity and me, and if I am eligible to take full input tax credit, I can adopt any value if there is no consideration for that matter. If you are paying any amount, Let's say you have a consideration, you are actually having an invoice, debit note, whatever name you call it. And if you're actually making a payment, then there is a consideration actually fixed. On that, you will pay reverse charge. But transactions where you don't have a consideration, those transaction gets covered in this. Even if you don't pay GST there, then there is no issue. So that is what the clarification is saying, and how this will be interpreted by the tax authorities, we need to wait and see, because this can be stretched to a lot of extent. This is defeating the entry in Schedule 1, which says when a transaction is happening between two related parties, even though there is no consideration, it should be treated as supply. But in one place, you're saying it should be treated as supply. But on the other hand, we are saying the value can be zero, which means I don't have to pay tax there. And this can be stretched to transactions of stock transfer. This can be stretched to transaction between any group entities within India, because the provision is the same. It applies to all these transactions. So we need to wait and see how this will be applied. But on the face of it, it's a very good move for the industry, where you are having any import of services from your overseas entity and you're not making any payment to them, you don't have to pay reverse charge there. Moving on, this is relating to the post-sale discounts. Basically, the valuation mechanism allows you to have post-sale discounts if these post-sale discounts are pre-agreed. Contractually, you have agreed that I'm going to supply X value of quantity to you, and I will be giving it to you at X value. And if you exceed the quantum, which is an industry practice, if you exceed the quantum, I will give you additional discounts. If these terms of your post-sale discounts are pre-agreed in your contract, and it is allowed as a deduction from your invoice. So whenever you are giving this post-sale discount, you will raise a credit note. When you raise a credit note, your customer has to pay less to that extent. Now, the issue that comes up here is this is allowed under GST. So when you raise a credit note, you will raise a GST credit note. Now you are reducing your tax liability because it's a GST credit note, and your receiver, whether he has reversed his input tax credit or not, is the question. What happens is there could be a timing difference, or there could be a scenario where you have given a credit note today and he has taken credit and he has continued to avail that credit, and he did the reconciliation only at the year end and he reversed at year end. So there is a revenue leakage there. Or it could be a scenario where he never reversed the credit. Now, what the authorities are saying, there is no mechanism right now in the law or in the GSTN portal where I can do a reconciliation. Whether the supplier is also taking benefit by reducing the supply, and the recipient is also taking the benefit of input tax credit. There is no mechanism rated for this. They're saying you need to get a certification or a declaration stating that the credit is reversed in the past period. So if you have supplied X amount to your customer, and then later on, let's say 2 months later, you have given a credit note to him, it is your responsibility that your customer has reversed input tax credit to the extent of your credit note. So now, based on this circular, authorities will start asking you as part of assessment whether your customer has reversed the credit. If he has reversed the credit, give me a declaration. If the value of this is more than 5 lakh, along with the declaration, you have to obtain a CS certification from your customer. And if the value is less than 5 lakh, you need to give a self-declaration from the customer is sufficient. But this is going to be a big challenge as part of assessments. Now, even though the circular is specific to post-sale discounts, there's nothing stopping the authorities from adopting this for any other credit notes. Because regularly, in a regular credit note scenario also, in assessment, they have picked up this point. They're saying, you have issued credit notes. How to prove it? You have issued credit notes. Now, there is no mechanism in the GST return to correlate this credit note with original invoices. So the authorities are asking, prove me that your credit note is pertaining to a specific period and you have issued a credit note within the timeline, and your customer has actually reversed the ITC. So this will get stretched beyond postal discounts. The authorities will definitely start asking for such declarations and certification for regular credit notes that you have given also. Moving on. Recommendations relating to zero rated supplies. This is exports. Critical for mostly this community where we have exports. If at all any of your exports is subjected to export duties, then right now also unutilized credit refund was not allowed for this, but now the amendment is going to be proposed in the section itself saying the refund for any goods which is exported out of India, if that good suffers export duty, then you will not get refunds. Now we need to wait and see how this is going to be implemented, because the export duty part of it, the customs authorities bring in certain goods for export duty and later they remove the export duty on those goods. So for those periods, whether it's going to be specifically only for that period, I'll not be able to get a refund, or it is a generic rule that any goods that get subjected to export duty will not get refund. We need to wait and see how this amendment is going to come through. The next point, again, it's a very welcome move. Right now, if you're exporting, let's say at the time of export, you may not know the exact value. It could be because your customer has to approve or whatever. Lot of business scenarios could be there where you will not be able to know the exact value at the time of export. So you will be creating a pro forma invoice and exporting these goods. And later when you realize that the value is lower, the export value goes up. In those scenarios, right now, there is no mechanism for you to get a refund. They're proposing that if the export value of your goods goes up later at point of time, they will bring in a mechanism to give refund towards the increase in the price of your exported goods. This is the recommendation which even KK Pillai sir highlighted at the beginning. The compensation cess relating to imposed by SEZ and SEZ developers, SEZ units and developers, which was a big issue for the entire sector as such. Now, this is a very good move where they have said that this is going to be a retrospective effect from 1st July 2017 itself. Compensation cess is exempted. The important thing here is that this was a miss, whether it's in the SEZ law or it is in the GST law. When they were giving the exemption, they had not highlighted these exemptions. It was exempt, let's say IGST is exempted. Nobody focused on compensation cess being exempted for imports done by SEZ. This amendment is actually overruling the judgment of the Andhra Pradesh High Court, but it's a good move. SEZ units gonna get relief because of this. All the investigations or the notices that is issued on this matter gets dropped because of this retrospective amendment. Now the next point, mostly applicable to entities who are supplying goods to B2C, if your customers are B2C, and it is predominantly for e-commerce sales. So what was happening is, in case of e-commerce sales, I'm supplying goods to, let's say I'm the seller, I'm supplying it through, let's say, an e-commerce platform. When I'm supplying, the order will say the bill to address is Karnataka and ship to address is Tamil Nadu. Okay. In these cases, there was confusion as to which state is the place of supply and which state should get the revenue. Now this gives a much more clarity, saying that it is not the bill to state, it is not ship to state. So there will be confusion because when it comes to registered receive payers, if your customer is a registered taxpayer, it is actually the bill to address. And if your customer is a B2C customer who is not a registered customer, then it is the ship to address. So this distinction has to be made, and any update in the ERP systems that the supplier is having should be done to give effect to this. So all his future invoices are complied with this. So one thing that we have to keep in mind, if you have bill to and ship to address, in case of B2C supplies, the ship to address is the place of supply that we have to adopt for the purpose of paying GST. So these are a few of the facilitation measures, all compliance driven. One more return. we have to wait and see how this is going to be, because already we feel that we are filing way too many returns in GST, right? So in a monthly basis, if you're ISD, then you feel you're filing almost 3 to 4 returns. Now there's going to be one more return between 10th and 20th. So we'll wait and see how this is going to be implemented. This is majorly to address the issue of amendments. So GSTR 1 didn't had an amendment provision, so we were not able to disclose something additionally if I've already filed GSTR 1. So this at least addresses that issue. But in my view, if they had given revision instead of a new form, a revision facility for GSTR 3B, that would have been much more effective, where I could have paid taxes or I could have taken more input tax credit. But let's wait and see how GSTR 1A new return is going to be there. Next is annual return. If your turnover is less than 2 crores, you don't have to file annual return. It is exempted for you. The due date for GSTR 4, which is for composition taxpayers, has been extended right now from 30th April to June. So it's again a good move wherein a lot of MSMEs gets benefited. The next point is critical, biometric Aadhaar authentication. So we have to wait and see how this is going to be implemented. One, from a government perspective, yes, it's a very good thing because you're going to avoid a lot of fake invoicing and fake registrations by implementing this. But how it is implemented is we need to see, because today, let's say I'm a director of a company, I'm sitting in Karnataka, and my entity is registered, let's say in Delhi, and it will be a very cumbersome activity for me to travel to Delhi to get a biometric Aadhaar authentication done and come back. So the facilitation that the government should provide should be in such a way, wherever I'm located in the country, if I want to get this done locally, I should be able to get it done, and it should reflect irrespective of which state the GST registration is. Hope they will bring in the mechanism that way, not mandating the authorized signatories to travel to the respective states. Next point is on the compliance part of it. Today, when you're filing your GSTR 1, there is a mechanism where you have to disclose your B2CL, which is business to customer large transaction. So the value of that large transaction was 2.5 lakh. So we were declaring any B2C transactions where the value is more than 2.5 lakh. We were disclosing line level data of that. Going forward, this limit has been reduced from 2.5 lakh to 1 lakh. So going forward, the number of transactions that you have to disclose in your GSTR 1 has gone up due to this change. So there are a few specific sector related changes. I'll quickly highlight. E-commerce operators, if you are a supplier, you are supplying through any other e-commerce platform, your e-commerce operator used to deduct 1%. When they're making the payment to you, they will deduct 1%, and they will pay this 1% to the government, and that will reflect in your electronic cash ledger. This was creating working capital issue for the MSMEs or any supplier for that matter, because I'm not getting that 1% directly into my bank account. It is going and sitting in the government portal. Now they've reduced this 1% to 0.5%, which is a very good move because it will free up working capital. Whether it's 0.5% also, it's a good move, which will free up the working capital for the MSMEs. Next one is, this is an amendment which came last year, wherein e-commerce operators were stated that they will be subject to all penalties for any non-compliance by the suppliers on their platform, which is a slightly stricter move and which is painful for the e-commerce operators. But now they have given more clarity, saying that this applies only if the e-commerce operator is involved in TCS collection, which is only if the first provision, that is at 1% or 0.5% related provision applies, then only the penalty related provisions also will apply. Otherwise, regular e-commerce operators, this penalty provisions will not apply. Now, the first 2 points are on TCS. Now the third point is on TDS. Like this is GST TDS. This applies only in scenarios where you are a supplier and you are giving services only to a government organization. Okay, if you're giving services to a PSU, a government organization, then you raise invoice on this government organization. Government organization, when makes the payment to you, they again deduct TDS. Okay, this TDS they deposit again to government to GST portal. So that becomes my credit, which I can utilize. Now in this mechanism, they are bringing in few clarity that the government organizations should file the return on a monthly basis. There is no relaxation for them. Even if there is nil transaction, they have to report nil transaction. Second, they have to give line level, invoice level information as part of this form, which is good because for the receiver, the customer, they will be able to perform better reconciliation to see whether actual credit has been received by them or not. Next, real estate and infrastructure. The first amendment, the clarification is pertaining to national highway authorities, where the contracts, HAM projects, the projects are such that it is pertaining to 15 years or 20 years. And the projects are not only for construction, also for maintenance and operation of these highways. So now the clarification clears that contractually, whatever the invoicing mechanism and payment mechanism that is there, as per that only the GST has to be paid, because the tax authority started splitting these contracts into two parts, specifically saying construction is separate and operational maintenance is separate, and they were trying to levy tax on it by splitting it artificially. Now that is being clarified. It's a single contract where construction as well as maintenance and operations are involved. So whatever the contract says as billing and payment mechanism, based on that only GST also applies. Now the last point on RERA, whatever charges that they are charging right now for pertaining to their activities, it's a government function. It is said that it is exempted and there will be no GST levy on it. This is for your consumption. I'm not gonna delve into the details of it. I'm just flashing the screen where the GST rates have been I would say changed or moderated in many cases. The first one relating to MRO activities, the concept is MRO related job work, they made it at 5%. Most of the activities were at 5%. So now they're saying any parts or goods that gets into MRO related activity will attract same 5%, which is a good move. You're standardizing the rate across for entire MRO activities. So these are few rate changes that is suggested. The clarifications that are pending. So the GST Council, as part of the meeting, highlighted certain changes. They said they will give XYZ clarifications. Now the set of clarifications that we got yesterday, we have discussed it till now, but there are still plenty of clarifications that are awaited, which might come through in the next 1 week, and we will have a lot of amendments also, which might happen through notifications in the next 1 week, or there will be certain amendments that has to be waited for the Finance Act during budget. Again, next month we will have the budget. So we need to wait and watch how these amendments and how these clarifications are going to come through. So it's going to be very interesting because the number of changes are so many, and it's going to impact each and every business from the compliance angle to the tax positions that they have taken, and also how they have to manage their operations going forward. So it's not a single amendment that is impacting only your compliance part of it. So there are plenty of amendments that is proposed. So it's going to be very interesting next 1 month, where a lot of businesses have to relook into the way they are performing or operating currently. So that's all. Thank you. Thanks for the opportunity. Over to you, Supriya ma'am.
This is Mr. Nagendra sir, I'm allowing him to talk.
Yeah, I
Hello,
wanted
Mr.
to raise
Nagendra.
a point, my friends. See, there are certain HSN code I found for the same products in two structure of duties. Say 12% duties, say for example, banana chips or light products, the dry products and all I found checking in the HSN code. Somewhere it is 12% and somewhere it is 5%. Two different items are. So the standardization is necessary for items which are spread all over. So I would request you to kindly take up these issues, because I may also be taking it up.
Supriya ma'am, I think there is some lag at PLICER's end.
Sir's net has gone.
Yeah. So I noted that point. I totally agree. There are cases where the tax rate is different. Even though the product is same, the tax rates are different due to certain very slight modifications. I agree that the authorities should ease this and bring in a single rate, so there is no room for interpretation on a single product.
Mr. Nagendra Papaya has raised his hand. Asking him to unmute.
Have you heard? Hello?
A little bit, sir. There
Yeah,
was
have
some
you
issue.
heard my
Yeah, he
submission? Have
noted that point.
you didn't? Our speakers did not hear?
Sir, there was a disturbance during a part of your speech, but he has noted that, sir.
So I've noted and I've highlighted that also, sir.
Oh, okay.
He
Thank
is
you.
not attending. Mr. Nagendran, and we have got questions. One is from Mr. Muhammad. We are 100% EOU. We normally applying for ITC refund from GST, but they will not consider ITC regarding machineries for refund. We don't have any DTA sales, so let me know how to claim this ITC.
So it's a very typical issue for EOUs where you will get refund of only your input tax credit on regular inputs and input services, not on capital goods. So capital goods, if you've already paid this credit and it is sitting in your credit ledger, it's a challenging task. Unless you have DTA sales, you'll not be able to get refund of it. But at least going forward, before you procure any capital goods, go through the deemed export route. Ask your vendor to consider it as deemed export, or you yourself consider it as deemed export and get refund of it instead of claiming ITC. That is the solution for EOUs on capital goods.
Also, just to add to Karthik's point, for the past, what you would also try is that if you have to make certain sales and if it is possible, make certain export sales with payment of tax and then claim a rebate, GST rebate. Because once you do a rebate or a refund claim of output GST, their segregation of capital goods and inputs is not done. So for the past accumulated credit, that's your best bet. Going forward, Karthik very well advised on how do you claim deemed export benefits. For the past, you can certainly go for a certain route of exports with payment of GST.
The question is from Motorola. When will changes get implemented?
So everything will have separate specific timelines. The clarifications are effective now, and there's still the notifications are not out, and there will be a lot of changes that will come out as part of the Finance Act. So only when the Finance Act is introduced and sent by the president, then only it will be implemented. So now only clarifications which are retrospective or from current period, that is applicable.
The question is from Palak Jain. Hi, what if we have already deposited tax interest and penalty under demand notice under section 73 for the financial year 17-18? Then now can we claim the interest and penalty?
So as I mentioned, in the session as well, that as of now, of course, there is no clarity with respect to the past payments that have been made for litigation. If you look at the past trends, wherever an amnesty scheme has been brought in, whatever payments have been made up to the date of the introduction of amnesty scheme, generally they are not refunded. So if past trends are to go by, this will not be refunded unless we of course see once the fine print of the scheme is out, because right now we don't even know how will one proceed under this and all the other open elements that I spoke about. So let's wait for the details, but past trends don't suggest a positive answer to this question.
Questions are over. A few questions I used to get every week is, shall I ask those one?
Yeah,
That is one is GST. When GST applicable on the second-hand sale of goods from SEZ to DTA, just like vehicles or something like that.
so it's an SEZ to DTA sale where the SEZ first has to debond the goods, right? It is owned by SEZ.
They told me that second-hand sales, they want to sell their
Okay,
second-hand
understood.
scooter
Understood.
like
So if you-
vehicles.
Understood. So see, it is not that it's not allowed. Let's say if it is an IT equipment, there are restrictions for you to sell it to a domestic entity. So second-hand goods, the only challenge that they will face is getting an authorization from DGFT for you to import into India. Because as much as the goods are with SEZ, it is considered as outside India. Okay. Now for you to bring it from SEZ to DTA, you need to cut a bill of entry. For cutting this bill of entry, and it is as good as importing into India. Importing any second-hand goods into India is restricted, and you need to get DGFT authorization. If they allow, definitely you will be able to take it into the DTA.
Will GST applicable on that or duty applicable on that?
Yeah, duty will be applicable at regular duty rates because it's an import. You'll be paying customs duties along with IGST.
And another one I used to get is if the units mainly
There is a
IT,
question
IT sector.
Supriya,
Yes,
there is
sir.
a question. I want to
Okay.
further clarify on that point. Suppose if it is taken from the DTA, it's not an imported machinery. It is a DTA machinery brought into the SEZ. Then after a certain period of time, they wanted to dispose it off. So they are giving to the DTA back.
So at the time of bringing into the SEZ, how did you bring it in? Whether you brought it into the SEZ as a temporary input of goods, wherein you will take a permission from the AO saying that I'm bringing these goods temporarily to the SEZ. Then I will be removing it after, let's say after 3 months, 4 months after usage. No issues at all. So because both are approval based.
No, no. My question is, we purchased it from
Okay.
DTA. Certain machinery SEZ units purchased.
Okay.
Okay. After a couple of years, they wanted to dispose it off to the outside, to DTA again, back to DTA, not an imported item. Then,
Okay.
to my knowledge, I think the duty is not applicable. Maybe GST you may have to pay
GST
for the value assessed.
Yes, yes.
Yeah.
You're right.
Thank you. Thank you.
Another one was from one of our IT units. They want to import a laptop as well as mobiles from their head office to their office in Kerala. What will be the procedure?
So this is on DTA or SEZ?
SEZ unit.
So SEZ units wants to import laptops and mobile phones from their overseas entity. That's understanding is correct? No, no restrictions as of now. See, you have this DGFT authorization for import of laptops and electronic goods, right? So that is not applicable for SEZs. So you will be able to import it into SEZ without the authorization. And this has to be first-hand goods. Again, that's a main issue.
Okay.
So
If it is second-hand one?
Second-hand, then again, your DGFT approval process has to come. Usually it doesn't come through for you.
A few questions which I used to face always. So
Sure.
if now we have not received any other questions, shall we wind it up then, sir?
I think there is one more question.
It's come. So that is from Arun Mohan. Now just sir said that said for ITC accumulated due to EOU for capital goods purchased to sale with payment of tax at the time of export and claim refund. In that case, there might be chance of Rule 9610B. Please clarify.
So I'll address that. So I understand what you're saying. EOUs are restricted from making exports with payment of tax because of this rule. Okay. Now what the industry is practicing is this applies to you only if you are taking benefit on your imports. but most of the EOUs are today are not taking benefits. So if you are an EOU, during that period, let's say you have not imported anything and you have not claimed the duty benefits, no restriction for you. But if you have imported by taking duty benefits, it's a fight with authorities. This third option, you have imported it, you have taken BCD benefit, no problem, but pay IGST. On your imports, pay IGST, which means you have not taken IGST benefit on your imports, then still this rule restriction doesn't apply to you. So you have multiple options for you to go for with payment of tax, even if you're an EOU.
Since are now coming. This is from Dibin Kuruvilla. Can SEZ unit avail subvention on pre-shipment loans for supplies to deemed exports?
Not clear with the question. Subvention on pre-shipment loans for suppliers to deemed exports. Not clear with the question.
Okay, I shall ask him to send a mail to detailed mail.
Yeah, that's great.
Another one again from Motorola H50. That is, I think, the mobile number. Alden, SEZ units doing supply to another SEZ under advanced license. Can you explain GST filing implementation?
SEZ units applying to another SEZ under advanced license. These goods are not coming into India at all. So there's not a supply for GST purposes. You don't disclose it anywhere in your GST return also.
Over.
So many other questions.
Yeah.
Yeah, we can wind up.
So there is no other question. So I would request YSR to extend vote of thanks. Sir, please.
Madam, thank you, madam. Respected chairman, sir, Sri Siddharth Tandon, Sri Karthik Mani, the professional tax service providers of BDO India, and my colleague Srimati Supriya madam, and all the valued participants. On behalf of EPCES, together with BDO India, I would like to extend my deepest thankful to every one of you for joining today for this insightful webinar. And this is very special occasion that very early we have done it, and is the first EPS region where this 53rd amendment bill of our GST Council is being taken, and it has been discussed very well. I want to express our appreciation to EPCES Chairman sir and the BDO speaker and all the regional directors and to all our participants for their time, attention and enthusiasm throughout this webinar. And your presence has made the event very meaningful and impactful. A special thanks to all the participants for their active participation and the thoughtful questions and contribution to these discussions we had. Sir, your engagement has made this webinar a dynamic and interactive experience for everyone. So I would also like to acknowledge the dedication of Srimati Supriya Madam, the Regional Director of Kerala region, and her team behind the scene for successfully conducting this webinar. Sir, before concluding, I would like to bring to all the participants that EPCES had played an important role and successfully achieved in bringing out the export benefits and the exemption from the purview of restrictions, which is helping our members in ease of doing their business. I would also like to inform that EPCES, that Export Promotion Council for EOU and SEZ, is doing query services in coordination with the EPCES knowledge partner and also with the knowledge of the BDO, whereby members can get reply by emailing their queries, doubts, clarification, if any, to query@epcs.in. Finally, I thank once again to everyone involved, and we look forward to your continued support in future activities of EPCES together with BDO India. Sir, now with the permission of Chair, we would like to conclude this webinar event. So shall we
Thank you very
conclude
much,
this?
sir.
Okay, we can conclude and.
Thank you very much. Thank you, video
Okay.
team.
Okay, have
Thank
a
you.
wonderful evening, and once again, thank
Thank you,
you all.
everyone.
Thank
Thank
you.
you.
Thank you all. Bye.
Thank you, madam. Done very
Thank you,
nice
sir.
and discussed very well.
Yeah, it
Yeah,
was a very fruitful one.
yeah, very fruitful.
Okay, thank you.
Thank you. Thank you.